Good morning. I'm Kim Abril, the founder and the portfolio manager of Global Quality Fund. And today in this video, I want to talk about the 4 attributes of our portfolio of companies for this video to invest in an attractive sector structure. So most of the people knows that there are some sectors, some industries that allow a few companies to maintain high rates of return on invest capital. So these are ratio that we are using too much, but I prefer to talk in other video, maybe in the next weeks, and to explain in detail why we use this ratio. But these few companies that maintain this high level of return on invest capital, they have to follow different characteristics. So you can find these companies in a mini monopoly, or you can find in a local monopoly, in oligopolies, or in a fragmented market when you can find a leader. So in my opinion, these high levels of return on invest capital and these attractive sector structures is a key factor that explains if a company is a quality company or not. So let me start with my first example. This is a PaySign. PaySign is a US company that is my example for mini monopolies. PaySign has a market capitalization lower than 300 million. For me, any company with less than 300 million market cap, this is a micro cap. So PaySign offers prepaid cards and specialized payment services to the pharmaceutical plasma industry. So here in Spain, it's really important because we have Grifols. He's a large cap company that this is one of the main players of the plasma industry. Plasma industry is an oligopoly structure because there are 3 companies that control more than 80% of the US plasma donation centers. These companies are Grifols, CCL, and Shire. But what is most interesting, and it is an unknown company, is that inside of the plasma industry, there are a sub-industry where there are 2 operators, 2 companies that they control 100% of the market, and they are in the prepaid card business for plasma donation centers. So when people goes to give blood to these centers, they receive in average from $30 to $45 for each time. So when they go out of the donation centers, they need to take out the money. So there are 2 companies with 2 cards, prepaid cards, that allow this business. One is PaySign, and the other one is a subsidiary of Wirecard that I try to remember that Wirecard bought from Citywire in 2011. So here at the bottom of the slide, you can see a table. This table is part of my internal valuation when I'm using my target price for Pays, but can help me to explain why PaySign is operating in a mini monopoly. So here at the top, you can see the number of plasma donation centers that you can find you can reach in US. So in 2011, this is my start numbers. You can find 500. And right now, at the end of last year, you can reach 805. So this is a business that is growing, and each year, so the industry in plasma can add in a range of 50 to 70 new plasma centers. So in the case of PaySign, so PaySign starts in this business in 2011. So the market share at that year, 2011, 2012, and 13, it's too low. So market share, it's less than 6%. So, but PaySign has the capacity to increase market share in plasma business from 6% to 37% at the end of 2019, because they have a better managed and a better prepaid cards than Wirecard. Wirecard has a lot of problems with the cards with his customers. So this is useful for PaySign to increase the market share. So the management is guiding for in the next 5 years to reach 50% market share in the prepaid card business. So what I want to show here is that in this business, there are only 2 companies, and where PaySign, it's right now 37% market share, but it's growing at least until 50% on 2024. So they only have to compete with Wirecard, and Wirecard is a big company that they have a lot of business, and one of these is his subsidiary that is working in this business. So really, the service of PaySign is much better than the Wirecard. So what I expect is that Wirecard can maintain this mini monopoly and can increase the market share, not at 50%, maybe at 60 or 70%. Let me start now with a second example. A second example is a local monopoly. So I want to use here one of our main positions, LDC, the French poultry business. This is our second position with more than 6% assets under management in this company. LDC is a company with 1,600 million market cap with net cash. So LDC is the leader in French in poultry products. So they have, in average, 40% market share against all of these products. Also, LDC operates in the convenience segment, and also it's making products in the poultry business and in derivative products. But the most important is the brands that LDC has. Here I want to show you 5 brands: Gaulois, Lowe, Maitre Coq, and Marie. And some of these brands, they have more than 50% market share. This is really important because across the history, LDC is growing organic and inorganically. So they are making own brands from his own growth, and then LDC is buying brands from competitors, right? Here at the bottom, in the left chart, I want to show you the different animal proteins and the growth across the history from 1985 to an estimate to 2035, right? So where you can see is that poultry is the animal protein that is growing the most. Is it growing 65% from 15 to 35 estimate, right? Also, the seafood is growing 30%. But if you look at the chart, you can see that the color from poultry business is it increasing across the time. So poultry business and seafood business, this is a healthy trend. This is the better trends in this business. So this is because LDC is one of our main positions. Also, you can see this pyramid. You can organize the levels from low level in terms of margins to high level. So when LDC started in this business, I think in the 60s or 70s, they only manufacture standard chicken. But across the year until now, they invest a lot in innovation, in research and development. They create a lot of brands. And right now, especially in French, LDC was at the top of the pyramid because they have branded products and they have value-added products. One important thing to make in France is that the French consumer has preference for local products, and this is different than other countries in Europe. So this one thing that we like, because this local preference or for local products is creating barriers to entry. So this we like too much. The third example is a oligopoly. For this case, I'm using Stryker Corporation. So this recent drawdown or slowdown in the market allows me to try to go to Stryker Corporation. This is a typical business that it's always expensive. They trade below to 25, 30 times P. But when you are in a recession or in a depression, this is the time to try to buy this kind of large caps and quality business. So Stryker, this is a company with market cap higher than 61,000 million. So this is a company that designs, manufactures, and markets different variety of medical equipments. But the most interesting here that is Stryker. It's a leader in the implantable devices. So this is a oligopoly business where 4 companies control more than 80% of the market. You can see here at the right chart table at the bottom that you have 4 companies: DePuy, Zimmer, Stryker, and Biomed, and all 4 companies has more than 80% of the market. Here, Stryker has 20%. Also, you can see the revenue number for each of the 4 companies. So, and it's most interesting because when you look the orthopedic joint replacement, so this is most interesting because when a doctor used to work with some implant for a patient, the replacement market is better because it creates high switching costs and it creates high barriers to entry, because when a doctor works with some implant from Stryker or Zimmer, they cannot use then some replacement piece from other company. They have to use the same company. So, and this is amazing for this kind of business. So search always for high switching cost to create high barriers to entry. So here you have an example of oligopoly with 4 companies that controls 80% of the market, and especially in the knee business, where all these companies control more than 50% of the market. And at the end, the last is a fragmented market, but where we can find a leader. So for this example, I'm using Inchcape. Inchcape is a small cap from UK. The market cap is a little bit less than 2,000, and Inchcape is the world leader, especially in distribution, but also in retail sale of premium and luxury cars. So I remember this business because I was shareholder of this business for the last 2 years, but then I think at the end of last year, I decided to sell because I can see different red flags about his level of inventory and about the financial structure, because the debt, the company is unreporting debt, and with my numbers, I can see here the net debt to EBITDA adjusted for listings was higher than 4%. This is my number. So if you look, the consensus number is it lower than 4 times. So, but Inchcape is the leader in distribution. So right now, distribution is 80% of the profits of Inchcape, and is it focused in emerging markets? I remember that in 29, Inchcape was changing his business from a cyclical business, because a retail business is a cyclical business and also is a business too much intensive in capital. So in 29, Inchcape is changing from a cyclical business to a recurring business, or more uncyclical and high margin business, with distribution, and especially in emerging countries. So right now, Inchcape is the global leader in a totally fragmented market with more than 850 companies. If you look the left chart, the bottom, you can see that the company in his investors presentation, is talking that in this market, in the distribution, not in retail, you can find more than 850 companies across the world. So all these 850 companies are present only in less than 3 markets. You can see here that Inchcape, who is the bigger, also with 3 companies more, but Inchcape is the bigger, is present in more than 20 markets. So this is an example of a clear fragmented market. And this is amazing for Inchcape, because Inchcape can grow organic, like from a range to 3 to 5%, and then also can grow inorganically, buying some of these 850 companies. So this is amazing for a business. Also, you have here in the right another table from the same presentation, the Investors Day, where Inchcape is telling us that the total industry passengers in new cars is across of 80 million across the world. But the target for Inchcape, because Inchcape is only focused in emerging markets where an OEM, they don't have interest in this market because it's small. So OEMs that are working in Latin America, in Asia, in Africa, they are trying to use high scale. So they are not interested in markets that they cannot use his scale. And this is the markets where Inchcape is really interested. For example, in the case of Latin America, Inchcape is interested in the 30% of the market, so across 1 million passengers cars for this business. If you look to Europe, so in developed countries in Europe, Inchcape only has interest in 50%. So this is a really small amount, right? But you look at Africa, when you look at Asia, this percentage is really high. So in average, Inchcape only has 1% of the market share on this business. Let me share it with you. So this is a business that we sold at the end of last year. And I try to remember that on one of our shareholder letters, I think it's for the the second quarter of 19, I wrote why we decided to sell this business. And here, well, this is in Spanish, but I want to change the link to English. So if you go to my webpage, then you can show the same in English. But this is an example why we sold this business. This is an amazing business, but they are reported in terms of debt and in terms of inventories. So for more information, you can contact me by email. You can go to my webpage, or right now you can go to my my YouTube channel, and where you have different videos. Right now, this is the first video in English, so I want to spend the next weeks try to make all the videos also in English. So if I'm going inside of the channel, you can see that here, well, here is Spanish, but no problem. So you have 3 different list of reproduction or groups. The first one is talk about the business cycle and how we protect the portfolio. The second one is about to talk about investment thesis or forensic thesis, because I like to focus in red flags. And the other one is English videos. And the last one, it's one of these videos what we are talking now. So to talk about the attributes of our portfolio of shares. So this is the first video in English, so I want to continue with the next video. So have a good day.